Want to be rich like us? Are you just starting out on your investment journey and wondering about the buzz around stocks versus ETF? Confused about which one might be right for you? You're not alone. It's a common dilemma for beginners like you. Welcome to Alpha Investments, where we guide you to financial freedom. In this video, we're going to break down the key differences between these two investment options, explore their advantages and disadvantages, and shed some light on which one could be a better fit for your financial goals and risk tolerance. Let's start with the basics. What is a stock? Think of a stock as a tiny slice of ownership in a company, like Apple, Amazon, or Tesla. When you buy a stock, you become a shareholder, owning a small part of that company. The price of a stock represents the value of that little piece. And when you invest in a stock, you're betting on the future success of that company. If the company does well, its stock price typically goes up, and your investment grows in value. On the flip side, if the company faces challenges and its stock price drops, your investment loses value. Investing in stocks is like putting your money into a fast lane. It can be thrilling, but also comes with a fair share of risks. That's because the value of a single stock can be quite volatile, meaning it can swing up or down significantly in a short period. This volatility is driven by various factors such as the company's performance, economic conditions, industry trends, and even investor sentiment. Take Tesla, for instance. Its stock has experienced dramatic price swings over the years due to factors like its innovative electric vehicle technology, competition in the EV market. What is an ETF? Now let's talk about ETFs, which stands for Exchange Traded Fund. An ETF is essentially a basket that holds a bunch of different investments such as stocks, bonds, or other assets. When you buy shares of an ETF, you're buying a tiny piece of that basket. One of the most appealing aspects of ETFs is their diversification. For example, an ETF like VOO, which tracks the S&P 500, holds shares of more than 500 of the largest publicly traded companies in the United States. This diversification is achieved by spreading your investment across numerous companies, sectors, and often across different asset classes. By doing so, ETFs can help mitigate risk. If one stock underperforms or experiences a downturn, it won't have a significant impact on the overall performance of a well-diversified ETF. Let's say you invested in an ETF that tracks the Nasdaq 100, which includes tech giants like Microsoft, Apple, and Google. Even if one of these companies faces challenges, your investment won't be as affected as it would be if you'd put all your money into a single stock from that index. Main difference between stocks and ETFs. When you buy a stock, you're putting your money into a single company, owning a tiny slice of that business. In contrast, when you buy an ETF, you're investing in a collection of assets, a bit like owning a piece of the whole pie instead of just a slice. This means that with ETFs, your investment is spread across multiple companies, sectors, or asset classes, lowering the risk. Which one should you choose? So you're probably wondering, given the advantages of both stocks and ETFs, which one should I choose? There isn't a one-size-fits-all answer, but let's look at some factors that might help you decide. First, consider your investment goals. What are you saving for, and when will you need the money? If you're investing for the long term, like for retirement or a down payment on a house, ETF are often favored. They provide a more balanced approach to investing, helping you ride out market fluctuations with less stress. If you're a long-term investor, you can potentially benefit from the steadier growth and lower risk associated with ETF. Next, think about your risk tolerance. How comfortable are you with the ups and downs of the market? If you're a more conservative investor, preferring a slower, steadier approach to wealth-building ETF might be your better choice. Because of their diversification, ETF generally experience less dramatic price swings compared to individual stocks. And now, let's discuss the cost factor. Both stocks and ETF have associated costs. Stocks usually don't involve ongoing fees, but ETF often have expense ratios. These are annual fees expressed as a percentage of the ETF's assets that cover the cost of managing the fund. Typically, these expense ratios range from 0.05% to 1% or more. While seemingly small, these fees can compound over time, eating into your returns. Therefore, it is essential to compare expense ratios when selecting an ETF and to consider whether the benefits of diversification are worth the ongoing cost. Diversification, a key advantage of ETFs, refers to the strategy of spreading your investments across different assets, industries, and sectors. This approach helps to reduce risk because if one investment underperforms or experiences losses, it won't significantly impact your entire portfolio. With ETFs, your investment is automatically diversified because you're buying shares of an already diversified fund. On the other hand, if you opt for individual stocks, you'll need to do the legwork yourself to create a diversified portfolio, which can be more challenging, especially for beginners. Another advantage of ETFs is their liquidity. Because ETFs are traded on stock markets, they're easily bought and sold during market hours. This means you have the flexibility to respond to changing circumstances or take advantage of new opportunities without having to wait. In contrast, if you hold individual stocks, you might have to wait until the next trading day to execute your trades, which can be frustrating if you're dealing with rapidly shifting market conditions. Now let's discuss some potential disadvantages. First, there's the limited control aspect. When you invest in an ETF, you don't have direct control over the specific securities within the ETF's portfolio. You're trusting the fund manager to make those decisions for you. This might be a downside if you prefer to have a more hands-on approach to your investments. In contrast, investing in individual stocks gives you complete control over your investment choices. And let's talk about taxes. When you buy and sell stocks, you might have to pay capital gains tax on your profits. Similarly, if you sell shares of an ETF for a profit, you'll likely owe taxes on that gain. However, there's an important distinction to make. If you hold an ETF for the long term and it increases in value, but you don't sell it, you won't have to pay taxes on unrealized capital gains. This is a benefit of investing in general. Just remember that while you won't owe taxes right away, you will eventually have to pay taxes on any capital gains when you decide to sell. So let's wrap up this video with a simple truth. Your journey through the world of finance should be as unique as you are. We hope we've helped you on your path towards financial empowerment. If you found this video helpful, don't forget to hit the like button. Subscribe to our channel for more insightful content and share this video with others who might find it useful. Remember, knowledge is power and sharing is caring. Until next time, keep learning, keep growing, and remember, you have the power to shape your financial future. Alpha Investments.